Hello traders, Gary Wagner here. It is approximately 11 o'clock in Honolulu, 4 o'clock in New York on Friday. Happy Aloha Friday, as we say on the islands. April the 11th, 2014, and this is the daily report for gold and silver, our weekend review. If we can look at this week, the best characteristic would be in like a lion and out like a lamb. As we go into the close on Friday, we have very, very quiet markets except for palladium, which is making quite a show, up about $13. But gold currently is trading in essence unchanged. Current screen print, $13.18 and change, puts it up around a half a dollar now. The low today, $13.40, the high, $13.25.20. As I said, basically unchanged on the day. Silver is trading quietly, but quietly lower, currently off about a nickel on the day, below $20, $19.96. The low has been $19.84, the high $20.23. More on silver towards the end of the show and today's weekly review. We will look at our weekly chart to kind of show the overall activity of the week. But the first thing that I did want to go over on today's weekend review is to update us on our current trades. Of course, we entered the market. We issued an aggressive buy signal towards the beginning of the week, Tuesday or Wednesday. Traders that took that call were long gold roughly at 1308, 1309, right in that area. We also entered right around $20 on silver. We then put out a conservative buy signal, and this was just the other day. Traders that took that call are going to be in anywhere between 1314 and 1315 in terms of gold. When we look at this chart, 340-minute chart, it is short term, but I'm looking to see how the trend is actually moving throughout the week. And I look at the different body sizes. You can see that towards the end of the week, this is that quietness. We are getting a candle size that is shrinking in terms of its actual size. But one thing that we can say about this market is we've watched it move up off of these lows. We have seen this market really move, I believe, in a nice orderly manner, in that we get these nice spikes, small retracements, which followed by a price spike that is a higher high. Of course, as it comes down, we have a higher low. Another spike, wouldn't be surprised to see a small little correction, and so on. Now, in terms of our strategy on this trade, we have a specific target that we feel comfortable that the market should be able to get to, and it's our target based upon our Fibonacci retracement studies as well as our Elliott wave. And here's what we're looking at. When we consider, and these, of course, are subcounts, we've got a wave 1 that comes in here. I believe that we are currently in our wave 2. Wave 1, any way you want to look at it or break the count up, is going to be a 1, 2, 3, 4, 5. On the way down, you're going to get something like an A, a B, and then a final C. Now, the reason I've drawn my arrows where I have is because when we look at a basic Elliott wave model, it states that your B wave should be roughly anywhere between 50 and 75% of the move that you saw in A. So in terms of a straight retracement, we have the market moving from about 1390 down to about 1275, and we should see the market move back up. If we get 50%, that's 1333 on the low side, and then on the high side, I would look for about 1364. That is our current target for this particular trade, because my sense is that once we have achieved this, we're probably going to get one more wave down, and that will probably be our C wave. And the reason that I've put this low in there is this is that 61% retracement level that you will typically get either in wave 2 or wave 4. It's more frequent to have the occurrence happen in a wave 2. But when we look at the overall action of the marketplace itself, the way that it came down, it definitely went right past the 50%, but didn't fall nearly to the 61%. It's kind of in nowhere land at 1275. And for that reason, because it has found support at an illogical point in terms of the fib retracement, we might in fact see it test this area one more time before moving into an impulse wave or wave 3. Now, there is a technical area that we can find when we look at this price point at 1275. And simply put, it is this top right here. Realize that as the market goes up and finds resistance in certain areas, and resistance is going to be indicative by finding a top and then backing off, obviously. One man's ceiling is another man's floor. You've heard me say that on many, many occasions, meaning that here it's resistance. So we're on the first floor looking up and we see a ceiling. Here we're on the second floor looking down, we see a floor. Support and resistance being part and parcel of the same thing. So in terms of the time parameters, now that's a different story because Elliott Wave doesn't really work with time as much. There are Fibonacci time extensions, but my sense is that I'm not as concerned with time as I'm concerned with price and price action, because that's what's going to make or break a trade. Not how long we're in the trade as much as where the price goes while we're in the trade. So as I said, my sense right now is that this is our basic target right here, and that target I believe is very, very achievable. Now, this is yet another way to look at the current price action. We're looking at a weekly chart, standard candlestick format. Each candle represents 1 week in time. So when we look at, for example, this week's trading activity, we can see it had a higher low, it has a higher high, it is a green body, meaning it opens on the low, closes on the high, and follows last week's pivotal point in which we saw it hit this low. This is at 1275 right in here and move up off that. This is our second week also consecutive where we've had higher pricing overall on the week. Now, I want to really draw your attention to these three candles on this weekly chart because there is a multitude of candle signals that can be found within here. Now, the first signal that we see, and it's a really strong candle, not by itself, but in conjunction with other indicators, and that's this candle right here. This candle is very much a hammer-esque candle type. And the reason I say ask is you really would like to see an absence of any kind of upper wick on hammers, but you can have a little one. The key criteria in defining this particular candle type is body size as it compares to the tail itself. Let's try to put a tail in here. Tail itself, the tail's got to be at least 2 to 3 times the length. The longer the tail, really the more powerful the signal, because what this candle type tells you is that, as I talked about, bears are in control here, bears are absolutely in control here. Here, the bears are able to take it down and make a new low on the day, as you can see, and a new low on the week. However, at that point, you get bulls coming in the market, they drive the market back up, and the market actually closes above where it opened. Color's not important in a hammer, but that's a good sign. But more importantly, it's that small-bodied candle. Now, this week's candle is what we call our confirming candle. And by a confirming candle, we have a green candle with a higher high and a higher low. That's one way to look at these three candles. Now, there's yet another way and another pattern that seems to be emerging, and that is that three-river star variation. Because realize on a three-river star variation, and this is a pretty good example right in here, you get a red candle, a star-like candle, meaning small body, followed by a green candle. Here's your confirmation. When we look at our spot market, though, because of the fact that it's a 24-hour market that closes only on the weekends, you're going to get a close and open that are identical, because it's just going on to the next tick. It's just carrying it over. So you're genuinely only going to see real stars, meaning this small body's gap below these two real bodies here, on something like a COMEX continuous contract where there's a true open and close for the session. But this right here is an example of a three-river morning. And this also is a variation of that three-river morning. And the reason I'm calling this one more of a variation is I would like to see the body size this week have been a little bit bigger, but I'm still okay with it. You can look at the market, and what you'll see is on the majority of these bottoms, in some form or manner, you get your concluding red candle, you get a small body, the pivotal candle, the doji, followed by this uptrend, this green candle. So you have these series of 3 candles kind of really being that V. And that V, of course, is really telling us that pivot point. You can really see it pretty prevalent in these charts. You can also see it in areas where they really didn't amount to much. However, this is a really, really strong candle pattern. For those of you who have already watched the chart this after the show, I really talk about this, the engulfing, and the dark cloud piercing line as 3 primary patterns that we see in terms of the frequency. They have a high rate of occurrence. For those of you who have not watched the after the show yet, I highly recommend that you simply go to recent videos, and all weekly members and daily members, of course, are grandfathered into the Chart This series. It's a free series, but you have immediate access, so you can go and watch that, and the links are there when you look at recent videos. But so when we look at the week as a whole, I'm quite satisfied with the action that we've had. We'll have to see what develops next week. Of course, we have a ton of data coming out, and it's really fundamentally based the way that this market's been moving. We've really seen these last moves up based a lot on some geopolitical uncertainty with Russia and Ukraine, as well as economic data that has surfaced. So we've seen a pretty strong week. Second week, I'm satisfied, and that really is where we stand currently in terms of our trade and our exit strategy. So traders, have gone ahead and pulled up a 4-day chart, standard candlestick format. But in this chart, really what I want to focus on is our current Elliott wave count. Because here's my sense. I believe that this double bottom, and this, of course, is a secondary part of the double bottom. We had another occurrence back in June, of course, of last year when we hit 1181. That's right here. And then here. So this double bottom, I believe, completed this long corrective winter we had where we saw the market literally come down off of a price point of about 1800, and we begin our new count here. I believe that what we saw here was our wave 1. I am currently counting this current activity as a wave 2, meaning here's our A, we've got our B, we've plotted where we want our B to go, and then one final possibly C down. Now what really excites me the most is the fact that once that wave 2 is complete, we have our wave 1 benchmark. And what that allows us to do is some very, very simplistic, but simplistic in terms of how we do it, some analysis and projections. And the best way really to do that is basically a Fibonacci extension. So what we're doing with the Fib extension is we're starting from the bottom of the rally, going all the way to the top. So now what we have is really our price move in wave 1. Now we're going to carry this down to where the bottom of this secondary wave is, and we don't have that yet, but let's assume that the market moves to those lows, call them 1265 or so. You can see I've moved this to 1267, and that's where we would start, of course, our basic extension. So what information we're deriving is this. We have our wave 1, wave 2 completes at some point, and then wave 3, because of the fact that wave 3 by definition cannot be the shortest of any of the impulse waves, our first move that we would look for, in other words a minimum move of wave 3, is going to take us to roughly 1480. Now the beauty of that is that right now this is that mother of all resistance areas that we have not been able to take out at around 1435, 1430 is actually a 76% extension of that. But then the next thing we can look at is, yes, in fact, it could be 100%, but you can also see the market, your wave 3 be 138%, 123, up to 161 would be the max in terms of different models. Now, when we plot those areas, and as you can see, we've really got to compress the chart, but you can see what kind of price activity we could in fact see. Now, I'm not looking for prices to go this high just yet, but you would have wave 1, you would have wave 2, and then let's say wave 3 went to 123% rather than 100%, you're looking at 1530. Now, the reason that these price projections are so high is that we're comparing it to the fact that wave one, this is our benchmark wave, has had roughly a $200 move up. So at minimum, we would get a $200 move up at the 100% mark, which would take us, as I said, to roughly 1460. That's my longer term projection on the market. Of course, right now, what we're really concerned with is this particular wave as it moves up. Where is it going to kind of fizzle out? And my sense is that on the upside or top of the target is roughly around 1362, that's 75%. We could see this market then fall one more time. And I would imagine if it's a standard classic C wave, it's going to have a low, and that low is going to be below the A. So A, B, and C. And so that is my short-term, or interim term, I should say, as well as my long-term projection currently in the gold market. So traders, I wish I could give you more bullish news on silver. I know we have a lot of our subscribers that follow silver and love to trade silver, but the truth of the matter is it's not trading in the same manner as gold hasn't been for the better part of this year. And what we have been able to isolate in terms of the characteristics of the market is that we've been in this defined range for the better part of, October of last year all the way up till now. The characteristics, high of 2150, 22 max, and in terms of support, the support area is running in at around 1958, another one at around 1920. The key to me is the fact that although we noticed gold break out of that long-standing resistance line, and we had the breakout beginning of 2014, you saw that during that period, silver just kind of lagged. Look at this. It sat flat, and then all of a sudden, it just spiked up, hit the top of this resistance line, of course, and then effectively traded lower from there. Now at the bottom of this support level right in here. My sense is for a long-term move to develop in silver, in other words, if we're going to see silver go to 24, 25, and as gold begins to move up, what we're going to have to see in terms of technical evidence, really, before I'm convinced that you've got any kind of market worth its weight in silver, so to speak, it's got to break above this long-standing resistance line. Now, it's a cascading, it's a resistance line that's sloping lower. So as time goes on, this price goes lower. So at some point, it's going to need to break above that unless price keeps drifting lower. And my sense is that we have way too much support in this area for that to happen. This has been Gary Wagner, wishing you, as always, good trading. Have a great weekend. We'll talk to you on Monday for another daily update and review. Bye-bye.